This summary provides a detailed overview of United Airlines 2025 Q3 earnings call, focusing on key financial metrics, management's outlook, risks, and significant statements. Introduction. The call began with an overview of United Airlines Holdings' third quarter 2025 financial results. Management emphasized that forward-looking statements are based on current expectations, and actual results could differ. Non-GAAP financial metrics were used, and historical operational metrics excluded pandemic years, 2020 to 2022. CEO Scott Kirby's key statements, industry transformation and United's competitive position. Kirby highlighted that the airline industry is undergoing a permanent and irreversible transformation, and United is strategically positioned to win by focusing on building brand-loyal customers. Resilience and path to double-digit margins. He noted that United's ability to grow earnings in the face of a challenging economic environment for airlines in the first 9 months of the year demonstrates the resilience of its brand loyalty strategy and its path to solid double-digit margins. Air travel is not a commodity. Kirby reiterated that air travel is not a commodity, and that predictions about industry restructuring are coming true, leading to an environment where United can achieve strong margins. Revenue advantages. Winning brand-loyal customers. United invests over $1 billion annually in customer product enhancements across all cabins, providing greater value to every passenger, from basic economy to premium classes. This focus on quality and service, delivered by dedicated employees, is creating a generational lead. Loyalty program potential. The company sees potential to double the EBITDA from its loyalty program in the coming years, calling it the pre-game warm-ups phase. Cost management. United is taking an opposite approach to traditional cost-cutting by investing more in the customer and focusing on profitable flight times rather than maximizing aircraft utilization. The main cost focus is on driving efficiencies through technology. Future outlook. Kirby expects United to add at least 1 point of margin each year, normalized for macroeconomic activity, leading to low double-digit margins in the current capacity environment. He anticipates further margin expansion as industry restructuring plays out, potentially moving United into mid-teens margins. CFO Mike Leskinen's key statements, strong third quarter results. Leskinen reported third quarter earnings per share of $2.78, exceeding guidance and Wall Street expectations. The pre-tax margin was 8%, which would have been a point higher without disruptions at Newark. Industry-leading cost performance. CSMX was down 0.9% in the quarter, benefiting from approximately 1 point of expense shifting to Q4, maintenance, and 1 point from labor contract timing. Fourth quarter and full-year outlook. Q4 EPS is projected to be between $3 and $3.50, bringing full-year EPS towards the better half of the $9 to $11 guidance range. United is positioned to be the only airline to grow earnings this year. Balance sheet and credit rating. The company is marching towards an investment-grade balance sheet, having eliminated expensive COVID lease financing. S&P upgraded its rating to be B+, the highest in over 2 decades, recognizing the business plan's success. Free cash flow. United expects to generate over $3 billion in free cash flow this year, trending above the 50% conversion target due to aircraft delivery timing. Long-term CSMX framework. With general inflation of 3 to 4%, United's CSMX growth is expected to be 1 to 2% annually from gauge growth and core efficiency. However, customer experience investments are expected to add about 1 point of CSMX pressure annually, which is more than offset by revenue generation, leading to an overall CSMX run rate of 2 to 3% annually. Key financial metrics and highlights. Revenue. Third quarter revenue increased 2.6% to $15.2 billion on a 7.2% increase in capacity. Consolidated TRASM was down 4.3% in Q3. Domestic PRASM was down 3.3% on 6.6% more capacity. Premium cabins outperformed the main cabin. International PRASM was down 7.1%. Premium revenues were up 6% year-over-year, with premium cabin PRASM outperforming the main cabin by 5 points. United experienced its all-time highest business revenue in the week of October 5th, with 3 of the top 5 best weeks occurring in September 2025. Industry revenues are expected to be positive year-over-year for all remaining months of 2025. Consolidated RASM is expected to improve meaningfully in Q4 year-over-year, with international RASM outperforming domestic. Q4 is projected to be United's best revenue quarter ever, with the highest absolute RASM of any quarter in 2025. Profit: third quarter EPS of $2.78, above guidance, $2.25 to $2.75, and Wall Street, $2.68. Pre-tax margin of 8%. Full-year EPS is tracking towards the better half of the $9 to $11 guidance range. United expects to be the only airline to grow earnings in 2025. Gross margin, implied through RASM/CSM commentary, while specific gross margin numbers weren't explicitly stated, the discussion around RASM and CSMX performance indicates a focus on margin expansion. The company reiterated its target of double-digit pre-tax margins in the long term. Operational performance. Summer was the busiest in United's history, with over 1 billion available seat miles in a single day and over 48 million customers flown in the quarter. Q3 saw the lowest cancellation rate for any third quarter in company history. 6 of 7 hubs ranked first or second for on-time departures. Over 290,000 customer travel plans were preserved by managing delays rather than canceling flights. Customer NPS score was up nearly 7% versus summer 2024. Newark achieved its best ever on-time departure and star D0 for any third quarter. More than half of regional flights now have Starlink installed, with the first Starlink-equipped Boeing 737-800 having taken off. Management forecasts for future quarters/years. Q4 2025. EPS projected to be $3 to $3.50. Consolidated RASM expected to meaningfully improve year-over-year. International RASM expected to outperform domestic RASM. Projected to be United's best revenue quarter ever. Full-year EPS tracking towards the better half of guidance. 2026. Expects to hire over 2,000 pilots and over 3,200 new flight attendants. CSMX expected to be 2% to 3% annually due to inflation and efficiencies, with an additional 1% pressure from customer experience investments. Expected to have some added expense relative to labor agreements. Premium capacity will be up 2 to 3 points more than total capacity. Investments in clubs are expected to more than double. Long term, targeting double-digit pre-tax margins, moving towards mid-teens margins through industry restructuring and margin expansion. Potential to double EBITDA from the loyalty program by the end of the decade. CSMX growth of 1 to 2% annually from efficiency and gauge growth, offset by customer experience investments, leading to an overall run rate of 2 to 3% annually. Free cash flow conversion to accelerate closer to 75% by the end of the decade. Significant risk factors. Macro volatility. While United has proven resilient, broader macroeconomic downturns could still impact demand. Industry disruptions. The transcript mentions disruptions at Newark, system-wide ATC challenges, and summer weather disruptions, highlighting operational risks. Labor negotiations. Negotiations with the AFA, flight attendants, are ongoing and could lead to increased costs once a new contract is ratified. Government shutdowns. While currently having a minimal impact, a prolonged government shutdown poses a risk to bookings and government-related operations. Geopolitical events. Restrictions on flying over Russia due to the Ukraine war create competitive disadvantages for U.S. airlines flying to China. Supply chain issues. Delays in aircraft deliveries from Boeing and Airbus, while improving, have impacted the fleet plan. Competition. While United differentiates through brand loyalty and product, competition remains a factor, particularly from other airlines attempting to pivot to a more premium model. Unprofitable flying. The industry still has a significant amount of unprofitable flying, which, while being scaled back, introduces uncertainty. Highlights. Strong Q3 financial performance, exceeding EPS guidance and showing earnings growth despite industry headwinds. Operational excellence. Record low cancellation rates and improved on-time performance. Customer loyalty strategy success, demonstrating resilience and a clear path to higher margins. Technology investments, driving both cost efficiencies and improved customer experience, e.g., Starlink Wi-Fi. Fleet modernization, progress in aircraft deliveries and cabin upgrades, seatback screens. Loyalty program growth, strong performance in loyalty revenues, and potential for significant future EBITDA growth. Balance sheet improvement, progress towards an investment-grade credit rating. Premium leisure demand, acknowledgement of its growth and positive impact on yields. Lowlights. International PRASM decline. International flights saw a notable decrease in PRASM for Q3. Latin America performance. Results in Latin America were described as disappointing, with elevated competitive capacity. Newark disruptions. The initial disruptions at Newark negatively impacted Q3 results. Labor contract uncertainty. While aiming for an industry-leading contract, the timing of ratification and associated costs remain a factor. Russian overflight restrictions, creating competitive disadvantages for U.S. carriers to China. Most important statements from CEO and CFO, Scott Kirby, CEO. For United, that's meant winning brand-loyal customers. The third quarter is another data point that is consistent with the structural, permanent, and irreversible changes occurring in this industry. He emphasized that air travel is not a commodity, and highlighted the generational lead United is building through its focus on brand loyalty and customer value. He also expressed confidence in achieving low-teen margins and eventually mid-teens margins as industry restructuring continues. Mike Leskinen, CFO. Customers are speaking with their wallets and are increasingly choosing to fly United because of our strong operational performance and the significant investments we made and continue to make in the airline. He also stated, our CSMX performance will be industry-leading, and confirmed that United is positioned to be the only airline to grow earnings this year. He further highlighted the strong progress towards an investment-grade balance sheet and over $3 billion in free cash flow this year. Conclusion. United Airlines demonstrated a strong third quarter of 2025, exceeding financial expectations and showcasing the resilience of its customer-centric, brand-loyal strategy. The company is well-positioned for future growth, driven by continued investment in customer experience, technological innovation, and a focus on profitable capacity. While acknowledging potential risks and ongoing industry transformation, management expressed confidence in achieving significant margin expansion and earnings growth in the coming quarters and years.